Hello and welcome to Pro Trader Strategies Market Commentary for Tuesday, August the 15th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters and I don't know what's in your portfolios. Therefore, what I'm doing could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. Having that out of the way, let's get it on with the economic data across the pond. All we really got was Great Britain because the French and the Italians had a bank holiday. So we did get German GDP quarter over quarter, came in slightly lower than expected at 0.6% versus 0.7% expected, but they revised last quarter's number up from 0.6 to 0.7, so that's kind of ends up being a wash in a sense. And then in Great Britain, we got the CPI numbers. Their CPI year over year came in at 2.6%. It was expected to be 2.7%. Remember, CPI is Consumer Price Index. And then their core Consumer Price Index year over year came in slightly lower than expected at 2.4%, expected to be 2.5%. So core CPI is usually the ones that's mostly more widely looked at, I should say, just because it strips out some of the more volatile aspects of that number. And then they got PPI, which is Producer Price Index, month over month came in at unchanged. It was expected to be a positive 0.4, so a little bit lower than expected there. That's the inputs coming in, but then when you look at the PPI outputs, that came in actually slightly higher than expected at 0.1% versus unchanged expected. So looks like producers are passing on or gouging, I should say, the consumer. If their inputs are lower, you would think that their outputs would be lower, but their outputs there are higher. A little bit odd there. And then here in the United States, we got retail sales coming in at 0.6%, was expected to be 0.3%, so nicely higher there. Last month's number also revised up. It was supposed to be a negative number there. Let me just double check that. It was supposed to be a negative 0.2%, came in at positive 0.3%, so 0.5% increase there. That's a pretty nice revision. And then when you add that into the retail sales from this month, much better than what it originally looked like last month. I remember the last month's number kind of missed on those retail sales, especially with the autos. And then also with the core retail sales, which strips out autos and is more widely looked at because of, again, the lack of volatility or the more volatile aspect of auto sales. This month's number came in at 0.5% higher than the expected 0.3%, and they also revised last month's number up from negative 0.2% to a positive 0.1%. So nice revisions there, plus a nice beat on those numbers as well. And then we got manufacturing out of the Empire State Index, came in at 25.2, expected to be 10. So knocked it out there, much better than expected there. We also got business inventories, which I don't usually really look at a whole lot. That came in at 0.5, which an increase in inventories is leading one to believe that they aren't moving inventory, but I've talked about this anytime we're starting to see the numbers like we're looking at now. Higher inventories very well could just be correlated to the fact that manufacturers are ramping up because they're seeing more demand. So anyway, that number is what it is. The other thing is the National Association of Home Builder Housing Index came in at 68, expected to be 64, so better than expected there as well. So all in all, really good economic data points today. Despite that, we have crude oil down on the day by about 17 cents just because nothing's changed. OPEC still completely cranking out the oil. Here we're starting to crank up oil here in the United States with the fracking as well. Anytime we get close to that 50 mark, they're going to start jacking it up. But yesterday we had a massive sell-off. It came down and tested the 50 Fibonacci level today and blasted through it. But it, look how it just kind of tagged my trend line here. That is going to act as support as well. Now that we've gotten above that trend channel, when it comes down and touches that trend channel again, it's going to want to kind of try and hold its own there, and it did hold that very well. But still off on the day slightly after yesterday's big sell-off, taking a bit of a breather. Then we've got gold coming off again today by about 11 points below that 61 Fibonacci level. That's going to act as support and resistance, and now that we're below that, it's going to act as resistance as well. A lot of people going into the equities, starting to put their money there. I mean, it makes sense when you start seeing the economic data that we've seen today as well. Onto the bonds giving it up a little bit, down about 18 points. They were down over a point earlier today, kind of a dead cat bounce, if you will. Well, I think it's going to go back straight down to this point of control in lockstep after this data points that we've been getting. It looks like the Dow Jones is in negative territory when you look at this chart right here, but it is in positive territory. It just opened up higher this morning and is just kind of off of the opening print, if you will. So, but still up 7 points on the day. We got NASDAQ up about 8.5 points at the end of the day, taking a breather after yesterday or the last couple of days, big rallies. And basically we've retraced that Thursday sell-off. So all of those market losses have been recaptured. Volatility really coming out of the markets today too. So we're seeing that volatility crush. So hopefully a lot of you guys were able to take advantage of that, sell some premium in those markets, because that was the time to do it. You don't always get a lot of time to get in there and sell that high volatility, but you can see volatility getting crushed all around. I haven't looked at the VIX on a chart yet, but it's definitely coming off quite a bit. E-mini S&P's up 1.5 on the day. We can look at the daily chart. Overnight, I mean, it was like rallying through the roof on some of that data that we got across the pond, but then it was pretty much a profit taking on our economic data. This is a little overdone to the downside, if you ask me. I think that the market is basically just trying to shake out the weak hands of the overnight rally. So a lot of times you'll see that when the market overnight is up a lot, that has a tendency to come in and the market tries to shake those weak hands out, and when they start capitulating, we might see a bit of a rebound. So for the rest of the day, I would probably be playing this to the upside for the most part. But right now, just almost unchanged. On to what I've done. Home Depot is an earnings trade. I tweeted out yesterday that I did a strangle in there in the August weeklies, and one of the things, if you guys watch these webinars, I hope you do, on earnings trades, I talk about exit strategy on these earnings trades. One of the things I do, if it's a loser, when I come in the morning and the probabilities beat me, I'll have a tendency to hold that off, maybe get a little mechanical on a strangle, roll down the untested side, collect a little bit more premium, increase my probability of profit, and lower my break-even area to a point where maybe it's currently trading at. So, but with Home Depot, I came in this morning, it was pretty close to being unchanged. We could look at this on a daily or break. We'll do it intraday chart actually. So let's go to like a 5-minute chart, and I can show you what happens. This is, we see this a lot, and this is why I cover all of these trades immediately off of the open, because you never know after things start moving where these things are going to go. If you are at a profit, cover it for whatever profit you can get on earnings that morning of. And I usually say within the first half an hour, I try and get it done within the first 15 minutes. I know there's not always a lot of people in there making those markets and making them a little bit tight, but at the end of the day, it's worth it. This morning, you basically had 15 minutes maybe to get out of that trade. I got out of it in like the first, I think it was like 10 minutes or so. It was got a little bit better than where I got out. But anyway, let's talk about this trade. I went in there in the August and sold the 147, 160 strangle, and I collected 92 cents for that, and I was able to buy it back this morning for 23 cents. So it got a little bit better. I think the best I saw it get was right around 18 cents, but that's the reason why to try and get in there. You know, it went down and traded 148.26, which my 147 calls would have been very close to being in the money, and they probably would have been worth about 60, 70 cents at that point. So cover those trades immediately off the open unless you're already at a loser and you're waiting for maybe a dead cat bounce to get out of that. So that's the takeaway from today. The other thing is I'm trying to get out of Philip Morris. It was looking a lot better today, but then or yesterday actually even, been working it for about a couple of days now, trying to get out for 60 some cents, which is a little bit better than 50% of my max profit. May have squeezed that one day too much. I think it's now trading closer to 80 cents, which is still very close to 50% of max profit. If I can get a bit of a pullback, I'm going to look to chase and get out of my trade in my IRA and probably out of my trade in my margin account. So that's about all I got for you guys today. Working this trade right now, just keeping an eye on it. Haven't added anything. I'm going to be looking at some more earnings trades later this afternoon, so stay tuned for that. Follow me on Twitter so that you can get firsthand on what I'm doing there, all right? One thing, I don't always give all the strikes on that unless it's outside of what my rules are for the earnings trades. If I do something a little funky, then I'll say what my strikes are. But other than that, you guys know what I'm doing on those strikes. I'm looking at basically the one standard deviation move. So go to ProTraderStrategies.com and you can sign up for that webinar, get all the rules and details in and around how to do those earnings trades. All right, so that's all I got for you guys. Oh wait, tomorrow or Friday we're going to be doing a webinar on the call diagonals, and those are great because we're kind of getting through earnings right now, and these are great setups for the next earnings season. And I'll show you how to set up this call diagonal. So basically we're going to try and pay for that extrinsic value of those calls that will be affected by increased in volatility during the next earnings cycle. So stay tuned for that one. Check it out. That's all I got for you today. If you can't take that, take it easy.